Welcome to Breaking News to Trading Moves. We're here to give you a shortcut to being well-informed by focusing on the core takeaways from what's happening in the markets. Today we're looking at a situation centered on a massive cross-border transaction. It involves Lukoil's foreign assets and key intervention by the U.S. Treasury. This move didn't just make a headline, it pretty much instantly created a list of winners and losers across energy and finance. We're going to walk through who the players are and why some sectors are feeling pressure while others just got a clear advantage.
And that's exactly the key here. We're looking at how one regulatory decision on a very specific type of deal involving sanctioned assets can just rearrange the competitive landscape for assets valued at, around $22 billion. We'll get into the companies, their stock tickers, and the logic behind why they're landing in these new categories.
Okay, so let's start with the main event. The U.S. Treasury rejected an offer to buy Lukoil's foreign assets. And as you said, the value is about $22 billion. That's a huge prize.
It is. The bid was led by a group that included Xtellus partners. But the reason for the rejection wasn't about the price. It was all about the structure of the deal. The offer was set up as a cashless securities swap style transaction.
Okay, hold on. Let's pause on that phrase, cashless security swap. For a lot of people, that's just jargon. What does that actually mean in this context?
It's really the crucial technical point. A cashless security swap is basically a sophisticated way to get around capital controls and the whole problem of sanctioned assets being frozen. Xtellus was apparently trying to use certain frozen Russian securities assets you can't really use in normal commerce as the currency to buy the Lukoil assets.
So instead of paying with dollars or euros, they were offering an exchange of paper assets that are otherwise locked up.
That's the idea, yes. And the Treasury's reason for the rejection was very specific. The Xtellus group was not authorized to use sanctioned securities in the transaction. This decision really draws a line in the sand. It closes off one specific avenue for financing these kinds of complicated geopolitical deals.
So that cashless mechanism is blocked, at least for now. Is the Xtellus group just accepting that?
Well, they are reportedly looking to escalate it, maybe apply for a special license to get an exception. But, time is not on their side. The negotiation window is open until January 17th, 2026.
So it's long game. And in the meantime, what about other bidders?
They're still very much in the mix. We should remember that. The remaining players include traditional energy majors like Exxon, Mobil, Chevron, and also private equity firms like Carlyle.
Okay, so let's get right to the market reaction then. If the Treasury basically blew the whistle on one type of play, who gets the advantage? Let's start with the winners.
Right. Category 1 is what we can call U.S. integrated oil majors with M&A firepower. This is probably the most direct group of beneficiaries. The Treasury's block tilts the advantage toward these large established operators. They don't need these complex security swap structures because they have, massive balance sheets and lots of cash.
They can just walk in with a straightforward cash offer. And that completely avoids the whole compliance mess that tripped up Xtellus.
Precisely. And these majors are just better set up to navigate the regulatory maze that comes with these cross-border deals. They have entire departments for this. So we're looking at companies like ExxonMobil, ticker XOM, and Chevron, ticker CVX. For them, this move just cleared some of the competition out of the way.
That makes sense. Simplicity and cash are now the main advantages in this race. What's the second category of winners?
Category 2 would be U.S. refiners that can benefit from downstream tightness. This is a bit more indirect. It's about the market dynamics that come from all this regulatory friction.
What do you mean by friction?
I mean, if the sanctions and the general difficulty of closing a deal like this slow down the transfer of Lukoil's refining and retail assets, well, that can keep the global market for refined products tighter for longer. The uncertainty sort of freezes that capacity and slows down any plans to optimize or expand that footprint.
So because it's harder to get these assets out of Lukoil's control, it acts as a kind of supply constraint on things like gasoline and jet fuel, which helps everyone who isn't Lukoil.
That's right. A tighter market for refined products supports higher margins for the big domestic refiners. They benefit from a higher crack spread because global supply is a bit constrained by all this geopolitical back and forth. The companies here are Marathon Petroleum, ticker MPC, and Valero, ticker VLO. They're in a better margin environment because of the headaches slowing down this sale.
Okay, so their benefit comes from the delay itself. Now, what about the third category? It seems like they profit directly from the difficulty.
Exactly. Category 3, sanctions, risk, and compliance services. This is the sector that sees complexity and sees revenue. When the Treasury blocks a major deal structure like this, it sends a message through global finance. It makes every company involved in cross-border deals take another look at their own risk assessments.
So if the rules get tougher, everyone has to hire someone to help them follow the new, stricter rules.
That's it. More uncertainty and more complexity around things like licensing, screening, and structuring deals just boost demand for high-end advisory work, for investigations, for compliance data. When a $22 billion deal hits a wall because of a compliance problem, it really highlights the cost of getting it wrong. The companies in this space are Thomson Reuters, ticker TRI, and FTI Consulting, ticker FTI.
It's a classic situation where friction in the market turns directly into billable hours for the firms that know how to navigate it. All right, so we've got a clear picture of who's in a good position here. But of course, for every winner, there's another side to it. Who's feeling the pressure from this decision?
Let's start with category 1 on this side. Alternative asset managers and deal sponsors exposed to regulatory friction. Now, we mentioned Carlyle is still a bidder, so you might ask why they're in a loser category.
That was my next question. Aren't firms like Carlyle and Blackstone able to raise billions in cash? Why put them here?
The difference is really about their business model and structural risk. For these firms, deals that touch sanctioned assets already come with a higher execution risk. The failure of the Xtellus bid, even though they weren't involved, just highlights how big those regulatory hurdles can be. It means these deals will have much higher legal costs, they'll take longer, and there's a greater chance they fail completely, which is what just happened to Xtellus.
So even if Carlyle moves ahead with an all-cash offer, the fact that the security swap failed raises the compliance risk and the cost for any non-traditional buyer trying to make a deal like this under a regulatory microscope.
Absolutely. The perception is now that the Treasury is watching the mechanisms of these deals very closely. That's a risk multiplier. So we're talking about Carlyle Group, ticker CG, and Blackstone, ticker BX. Their business is built on executing complex deals efficiently, and this environment makes that much harder.
Okay, moving to the second category. This one seems a little further away from the initial deal. Airlines and plan. If oil risk premium rises, how does a blocked bid for energy assets hit Delta and United?
This gets into the broader geopolitical picture. Lukoil is a Russian-linked company. The Treasury's action is a very strict enforcement of sanctions policy. It sends a message. And anytime you see this kind of regulatory friction introduced, especially when it delays the sale of major energy assets, it can add a geopolitical risk premium to crude oil and, more to the point for airlines, to jet fuel prices.
So it's not an actual supply change, but the market's perception of risk that drives up the cost.
That's it. Traders price that risk in, and that premium directly eats into airline margins. It just makes their operations more expensive overnight since fuel is such a huge cost for them. So for Delta Airlines, ticker DAL, and United Airlines, ticker UAL, even a small, steady rise in fuel costs because of this can put a lot of pressure on their quarterly results.
And finally, let's look at the third category here. Large asset managers facing frozen asset headaches. This feels similar to compliance, but from a different angle.
Correct. This isn't about them trying to make a deal. This is about the passive compliance burden for the world's largest asset managers. The issue is their residual exposure. The Treasury rejecting a bid that tried to monetize sanctioned assets makes every asset manager, especially those handling trillions of dollars, a little bit nervous about what other sanctioned exposure might be buried in their funds.
So it's not that BlackRock or Invesco were trying to buy these assets, but they might hold other things that now get more scrutiny because this enforcement action just set a new tone.
That's the burden. It means more internal compliance work, more sensitivity around their reputation, and having to answer more questions from clients about exposure to these kinds of assets. It forces them to do a costly review of their portfolios. The firms mentioned are BlackRock, ticker BLK, and Invesco, ticker IVZ. They face a renewed compliance task just because the Treasury showed how seriously it's taking the rules on these frozen securities.
So to sum up, we've covered the U.S. Treasury's rejection of that security swap offer for Lukoil's assets, valued at $22 billion. It's a clear case of how regulatory and geopolitical factors can favor cash-rich, traditional players.
The dynamics are pretty clear. The integrated oil majors, the refiners, the compliance firms, they all benefit from either less competition or more complexity. On the other hand, alternative asset managers, airlines, and the big index fund managers are facing higher costs and more uncertainty.
And as we close out, here's something to think about. The path for traditional players like Exxon and Chevron to acquire $22 billion in assets just got a lot clearer. So how will that regulatory clarity affect the speed and maybe more importantly, the final price of the offers they end up putting on the table. That's what we'll be watching next.
Before we go, we must provide a clear disclaimer. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.
Thank you for listening.